Hi, this is an update of the Northstar Income Fund and its positioning. Since the sell-off of markets in March, asset prices have bounced back strongly. As a result, the Northstar Income Fund has fared well over the quarter, with the bulk of the return contributions coming from the 80% holdings in fixed and inflation-linked bonds. The fund has also fared well over 1 year, outperforming 3-month cash by 90 basis points and the average peer by 2%. Looking ahead, the question is, where do we see value given the negative impacts of the COVID crisis, the poor growth prospects, and the impending fiscal crisis? The good news is that the government is facing up to this problem and has realized that in order to avoid a full-scale IMF support program, it needs to show a strong commitment to fiscal consolidation, which it addressed to some degree in the recent supplementary budget. Execution risk is high, and coupled with increased issuance, we expect asset prices or the volatility to remain elevated. Over the quarter, inflation softened further to 3% year on year, predominantly as a result of the lower oil prices, which fell by 13% over the year. Conversely, food, insurance, and electricity provided upward pressure, these components making up 30% of the basket and are cost push in nature. Against this backdrop, we have a preference for shorter dated inflation-linked bonds, which will outperform fixed bonds in an environment of inflation coming in above 2.5%. Secondly, the 6-year R186 bond is trading on an attractive 5% real yield. As such, the Northstar Income Fund has a predominant exposure to these two range of bonds. The Northstar Income Fund is trading on a yield of 6.5% with a relatively low exposure to credit. However, where we do have exposure, it is high quality. In addition, the portfolio maintains a sizable holding in foreign currencies, which will hold its value in any risk-off event. The one major factor providing support to fixed income asset prices has been the 2.75% drop in interest rates since the start of the year. With a further 50 basis points interest rate cuts expected by the end of the year, coupled with sustained low yields in developed markets, will be supportive of fixed income asset pricing.